The market is crashing, stocks are plummeting, Bitcoin is tanking, even gold is down. It's a bloodbath out there, and investors are feeling the heat. The financial world is in turmoil, and it's not just the stock market that's taking a hit. Cryptocurrencies, which many thought were safe havens, are also seeing massive declines. Even traditionally stable assets like gold are not immune to this widespread panic. The fear is palpable, and it's spreading like wildfire. What's going on? Investors are scared, folks. They're worried about a recession. The signs have been there for a while: rising inflation, supply chain disruptions, geopolitical tensions. All these factors are converging to create a perfect storm. The uncertainty is causing a massive sell-off as investors scramble to protect their assets. The fear of an impending recession is driving people to liquidate their holdings, leading to a downward spiral. And for good reason. The Dow Jones dropped almost 900 points. That's huge. This kind of drop is not something we see every day. It's a clear indicator that the market is in distress. Traders on the floor are in a frenzy, trying to make sense of the chaos. The sharp decline in the Dow Jones is a wake-up call for everyone. It's a signal that things are not okay, and we need to pay attention. The S&P 500 and NASDAQ, getting hammered too. These indices represent a broad spectrum of the market, and their decline is a testament to the widespread nature of this meltdown. Financial analysts are glued to their screens, trying to make sense of the data. The charts are all showing the same thing: massive drops across the board. It's a tough day for anyone with money in the market. This is the worst day of the year for the markets. It's time to pay attention. Headlines are screaming about the market's worst day, and it's hard to ignore. The exterior of the stock exchange looks gloomy, reflecting the mood of investors worldwide. This isn't just a blip, it's a significant event that could have long-term implications. It's crucial to stay informed and understand the gravity of the situation. We haven't seen drops like this since 2022. Remember 2022? That was a bloodbath. The market crash of 2022 was a harsh lesson for many investors. It was a time of great uncertainty and loss. The current situation is eerily similar, and it's bringing back memories of that difficult period. The charts from 2022 show significant declines, and we're seeing a repeat of that scenario now. But you know what? Those who bought during that downturn, they made a killing. History has shown that market downturns can be opportunities in disguise. The investors who had the foresight and courage to buy during the 2022 crash reaped significant rewards when the market rebounded. It's a reminder that every cloud has a silver lining. The key is to stay calm and look for opportunities even in the midst of chaos, because the market always bounces back, and when it does, you want to be on the right side of the trade. The market is cyclical, and history has shown that it always recovers. The upward trend charts are a testament to this resilience. Investors who position themselves wisely during downturns often find themselves in a favorable position when the market rebounds. It's all about timing and strategy. This isn't the time to panic, it's the time to get smart, to understand what's happening and why. Panic selling only exacerbates the problem. Instead, take a step back and analyze the situation. Attend financial seminars, read reports, and do your research. Knowledge is your best ally in times of market turmoil. Understanding the underlying factors can help you make informed decisions, because knowledge is power, and in the market, power means profits. The more you know, the better equipped you are to navigate the ups and downs of the market. Financial analysts and successful investors spend a lot of time studying market trends and data. Their success is not just about luck, it's about being informed and making strategic decisions. So, arm yourself with knowledge, and you'll be better prepared to turn this market meltdown into an opportunity for profit. So, what's got everyone so spooked? Let's break it down. The financial markets are in turmoil, and it's not just a minor hiccup. Investors are on edge, and the atmosphere is thick with anxiety. But why? What are the underlying factors causing this widespread panic? Let's dive deeper into the 5 major reasons behind this market meltdown. First up, Trump's tariffs. These aren't just any tariffs, they're part of a broader trade war that has been escalating for months. The uncertainty surrounding these tariffs is causing ripples across the global economy. Businesses are unsure about future costs, and this unpredictability is making it difficult for them to plan ahead. The result? A jittery market. Uncertainty is the market's worst enemy. When investors don't know what to expect, they tend to pull back, leading to decreased market activity and increased volatility. This uncertainty is compounded by the erratic nature of the trade war, which seems to change direction with every new tweet or statement. And Trump's unpredictable trade war? That's uncertainty on steroids. One day it looks like a deal is within reach. The next new tariffs are announced. This back and forth is exhausting for investors and businesses alike, leading to a lack of confidence in the market's stability. Is he going to slap more tariffs on China? The question lingers, creating a cloud of doubt over the market. Every new tariff announcement sends shockwaves through the economy, affecting everything from consumer goods to industrial supplies. What about Canada and Mexico? Nobody knows. The uncertainty isn't limited to China. Trade relations with other key partners like Canada and Mexico are also in flux. This unpredictability makes it hard for businesses to make long-term plans, further destabilizing the market. And that's got investors hitting the sell button. When uncertainty reigns, the natural reaction is to minimize risk. For many investors, this means selling off stocks and moving to safer assets, which only exacerbates the market downturn. Second, inflation is out of control. And these tariffs? They're only adding fuel to the fire. Higher tariffs mean higher costs for imported goods, which in turn drives up prices for consumers. This inflationary pressure is making it harder for people to afford everyday items, leading to decreased consumer spending. They're only going to make things worse. As prices continue to rise, the purchasing power of consumers diminishes. This creates a vicious cycle where decreased spending leads to lower corporate revenues, which then results in further market instability. Prices are going up, and there's no end in sight. The longer this trend continues, the more it will erode consumer confidence and spending power, creating a drag on the overall economy. And that's eating into corporate profits. Bad news for stocks. Third, the Federal Reserve. The central bank is supposed to be the stabilizing force in the economy, but even they are struggling to keep things under control. They're supposed to be the adults in the room. But their economic forecast, grim. The Fed's recent statements have been anything but reassuring. They're predicting slower economic growth and potential rate hikes, which are not what investors want to hear right now. They're predicting the economy will shrink in the next quarter. Not good. A shrinking economy means lower corporate earnings, higher unemployment, and a generally less favorable environment for investment. Fourth, U.S. fiscal policy is a mess. We're drowning in debt. The deficit is exploding. The government's fiscal irresponsibility is another major concern. High levels of national debt and a growing deficit are unsustainable in the long run. And now there's talk of spending cuts and tax hikes. These measures, while necessary to address the fiscal imbalance, could further strain an already fragile economy. Spending cuts could lead to reduced public services, while tax hikes could decrease disposable income for consumers. That's a recipe for disaster. The combination of high debt, potential spending cuts, and tax hikes creates a precarious situation that could easily tip the economy into a recession. Finally, CEO sentiment is in the toilet. The leaders of major corporations are losing confidence in the economic outlook. This lack of confidence trickles down through their organizations, affecting everything from hiring decisions to capital investments. The guys running the show, they're not feeling optimistic. When CEOs are pessimistic, it sends a strong signal to the market that things are not going well. This can lead to reduced investment and hiring, further slowing economic growth, and when they're not feeling it, neither are investors. The overall sentiment in the market becomes one of fear and caution, leading to a self-fulfilling prophecy of economic decline. So, there you have it. 5 major factors driving the current market panic. It's a complex web of issues, each feeding into the other, creating a perfect storm of uncertainty and fear. Okay, so things look bleak, but hold on. Before you make any hasty decisions, let's take a step back and look at the bigger picture. It's easy to get caught up in the doom and gloom of the moment, but history has a lot to teach us about these situations. This is not the time to bury your money in the backyard or stuff it under your mattress. While it might feel safe to hoard cash, doing so can actually be detrimental in the long run. Inflation can erode the value of your money, and you miss out on potential gains. This is the time to buy. Yes, you heard that right. When the market is down, it's like a sale on stocks. You can pick up quality investments at a fraction of their usual price. Think of it as buying your favorite products at a discount. Don't believe me? Let's talk history. The stock market has a long track record of bouncing back from downturns. It's been through wars, recessions, and even depressions, yet it has always recovered and gone on to reach new highs. Remember 2008, the financial crisis? The world was ending, right? Banks were failing, and the stock market was in freefall. It was a scary time for investors. Wrong. Those who bought stocks then made a fortune. The market rebounded, and those who had the courage to invest during the downturn saw significant gains in the years that followed. Because what goes down must come up. It's a fundamental principle of the market. Corrections and bear markets are temporary, but the long-term trend has always been upward. Or how about 2020, the pandemic crash, the fastest crash and recovery in history? The market plummeted as the world went into lockdown, but it didn't take long for it to bounce back. Those who bought the dip, sitting pretty right now. They took advantage of the lower prices and are now reaping the rewards as the market has surged to new heights. And let's not forget 2022, the market tanked 20%. Brutal, right? It was a tough year for many investors, with significant volatility and uncertainty. But those who held their nerve, those who bought when everyone else was selling, they understood that downturns are part of the market cycle and saw it as an opportunity rather than a threat. They're laughing all the way to the bank. Their patience and confidence in the market paid off, and they're now enjoying the benefits of their wise investments. The market always recovers. Always. It's a resilient system that has weathered countless storms and emerged stronger each time. History is full of examples of this resilience. And every downturn is a buying opportunity. When prices are low, it's the perfect time to invest in solid companies and assets that will grow in value as the market recovers. Don't miss out on this one. The current downturn is just another chapter in the market's long history of ups and downs. Be smart, be patient, and take advantage of the opportunities that come your way. Now, I'm not saying you should throw all your money into the market tomorrow. You need a strategy. And one strategy I love is always be buying, or ABB. Here's how it works. You invest a fixed amount of money at regular intervals no matter what the market is doing. Up, down, sideways, it doesn't matter. You buy. Why does this work? Because when the market dips, you're buying stocks at a discount, and when the market recovers, you're reaping the rewards. It's like dollar cost averaging on steroids. ABB takes the emotion out of investing. No more trying to time the market. No more second guessing yourself. Just consistent, disciplined investing. Section 5. Active investing, spotting the diamonds in the rough. Now, ABB isn't for everyone. Some people like to be more hands-on. They want to research individual companies. They want to find those hidden gems that are poised to explode. That's active investing, and it can be very profitable. But it takes time, and research, and a strong stomach. You need to understand the businesses you're investing in. You need to read financial statements. You need to follow the news. It's not for the faint of heart. But if you're willing to put in the work, active investing can be extremely rewarding. You're not just riding the market, you're beating it. Section 6. Calm under fire. Your keys to investment success. No matter what strategy you choose, one thing remains crucial. Stay calm. The market is a roller coaster. It has its ups and downs. But if you panic and sell every time it dips, you'll never make any money. Remember, the market rewards patience and discipline. Don't let fear drive your decisions. Stick to your strategy, and you'll come out ahead in the long run. Section 7. Your money, your system. Building a solid foundation. Before you even think about investing, you need a solid financial foundation. That means having a budget, paying off your high-interest debt, and building an emergency fund. Once you've got that covered, you can start thinking about investing. But don't invest money you can't afford to lose, and always diversify your portfolio. Don't put all your eggs in one basket. Section 8. Know your playbook. ABB or active, stick to your guns. Choose an investment strategy that aligns with your risk tolerance, your time commitment, and your financial goals. And once you've chosen a strategy, stick to it. Don't jump from one strategy to another. That's a recipe for disaster. Consistency is key in investing. Stay the course, and you'll reach your financial destination. Section 9. Ready to dive in? Free workshop to supercharge your investing. Want to learn more about how to turn this market crash into a golden opportunity? Join me for a free workshop where I'll dive deeper into these strategies and more. We'll discuss everything from market analysis to portfolio construction. I'll share my insights and answer all your questions. This is your chance to get ahead of the curve and start building real wealth. Don't miss out.